Well, hello there and welcome everyone to the Advisor's Edge podcast. I'm your host, Rob Jacoman, and I am super honored and grateful. Once again, we knocked it out of the park. We have an amazing guest on with us today, and we were going to introduce our guest in a minute, but I want to welcome Chad Ramberg, my trusty and good friend and co-host to the show. How are you doing, Chad?
Yes, sir. We're doing good here. Life is an adventure for sure.
That's awesome. Well, yes, it's beautiful here in sunny Maryland, and we're super grateful that the great weather is upon us, and we're going to have a great summer. I could just feel it. So I want to introduce an awesome guest, and who has also an amazing story that I cannot wait to dive into and share with you guys. We have Steve Selengut, and he is called the Income Coach. Not only is Steve an income coach and has a phenomenal coaching business, but Steve also has so much experience in this industry, and he's filled with value, and he's going to share some really great stories with you about his journey in the RIA space. And I think it's going to really help you guys out, especially those of you who are on the M&A side. Steve has a great story, which we're going to share and we'll dive into in a second. So Steve, welcome to our show. We're super honored to have you.
Thank you. It's great to be with you.
Yeah. The
I
great
hope
thing.
I can give some value to your, to the discussion here.
Absolutely. I think you will. I mean, I've read your book, Steve. I really enjoyed it. And as I was going through the book, I was thinking, I learned some stuff, which was good. And then I was thinking about it from the advisor's perspective. How could this be helpful for advisors? What type of advisors? Your multiple decades of experience is really cool. It comes through in the quality of the book. And I think there's different aspects of it. So we'll touch on that as we go through this. And also, you've always got some interesting stories to tell. So thank you for taking a little bit of time out of your, we'll call it semi-retirement. Obviously, you're the sort of guy that just keeps going.
Yeah, I've got that. I guess it's genetic. My father worked pretty much forever, and apparently I'm going to do the same.
There we go.
It's awesome. All
right. So diving in here, the first thing, what I would love to do, so the book that you wrote, and Steve, your experience in advisors, it comes through that you've been an advisor, you've had a ton of conversations with clients, and it felt like I was sitting there with you and your clients as you go from the very beginning, meeting them on a cruise, and kind of how that developed into, a couple of client meetings and going through that. What was the inspiration for the book where you said, hey, I think the world needs this? Tell me a little more.
It gets to the point when you get in your 70s, particularly in your late 70s, where a legacy thing sort of comes in there, say, hey, I've done this. I've had this wonderful career in life that's really been made up of this income-focused investing thing that I kind of developed a unique approach to over the years. And it's something that I thought a lot of advisors could take advantage of if they understood it and develop a practice that would be more in line with what older clients need than the market value focused environment we're in. So I was thinking in those terms that I would get the word out not only to advisors but also to the general public, so that they could start demanding this of an advisor and say, hey, I love you, but you're giving me 3% income. And after your fees, I don't have enough to pay my expenses, and we have to sell stuff this year. I know there are securities out there, I know that now, that can pay me 5, 6, 7, 8% safely and regularly. I want some of those in my portfolio. I want my capital to grow, not to be diminished each year for my expenses. Help me, or I'm going to find somebody that will. I think that's necessary. I really do.
And by the way, Chad,
go ahead.
By the way, Chad, we want to give a plug to Steve's book because, obviously we want anyone who would find value and benefit from it. Obviously, it's called The Retirement Money Secrets. And it is an amazing book. And it really, it's exactly what Steve just described. It really focuses on, walking through what does the client journey look like, and how can financial advisors empower themselves to provide that kind of experience to their clients. So yeah, let's dive deeper into that, Steve.
Okay. I can start. I managed money for all these years, and even growing up before I became a manager, I had an income focus. Even in the stock market portfolio I had, because they were all income payers. And my broker and I at the time broadened it out to have an income focused position as well. 30% of the assets were put in things like Ginnie Mae's and corporate bond trusts and individual municipal bonds and things like that. But it was an income focused portfolio. We didn't own anything that didn't pay income. And we also recognized the cyclical nature of markets and their upward trend, and simply the cyclical nature of the interest rate sensitive market, where it's up and down depending on expectations, period. And so we began to take target profits. We looked at these things and said, we can regularly take 10% profits on the same universe of dividend payers over and over again as they cycle through time. And we did that. And within 9 years of when I came into some money and had this investment portfolio that I was running, within 9 years, I was making 5 times what I was making in my commute job to New York City. And that was a job in which my wife said, there's really nothing happening there. You're not gonna, with your attitude and your abruptness with people and telling them what you think, you're not going to get ahead in that environment. And she was right. So that's when I made the decision that if I can make that kind of money myself, I can do it for my friends, family, and other people. And that's when I had enough income that I could afford to say goodbye and start finding clients. So that's the type of approach I always applied. It's an income focus using the stock market and using income purpose securities as part of it. And it just grew and grew.
And you have the cool thing about the book, when you get to the later chapters, you walk through kind of your rules that you set up for yourself and how to think about that, how to select, take profits, go back in, and grow and develop as you go, which I think is fantastic for the advisor, maybe a newer advisor that's still establishing their principles, right? I think this could be a helpful tool.
Oh, I agree. I think particularly someone who's lucky enough to work in a small firm, where they have some control over the types of things they want to bring to their own individual clients, that they don't have to just sell the model portfolios. They don't just have to do this or everything. You remember, you guys date back long enough to know about the stock of the month or stock of the day, where they'd send out a communication to all the brokers, and everybody who worked for them had to push ABC stock, to all their clients. You don't want to have to do that. You want to be able to say, hey, this client's 58 years old. He's thinking of retiring. I have to provide him income. This guy's 35 years old. He's not so much interested in income as he is in growth, and have different portfolios for them, but not just another model. This model's for the young guy. This model's for the old guy. They're both the same, and they don't pay any income. So, that's what I'm about. Let's get advisors to the point where they say, I know you need income, so let's build an income portfolio for you. We can do that.
Well, and you found a specific package type of investment that worked really, really good for that income focus.
Right.
Tell me more about that. Kind of how'd you get there, and why? In the book you go into great depth, but at a high level, I would love to hear your short elevator answer to that question.
Well, the elevator answer is there are a myriad of securities that pay significant income. There are preferred stocks pay more than ordinary stocks. High dividend, high quality companies pay, utilities in particular, pay higher dividends. Then you have things like REITs and master limited partnerships and business development corporations and CLOs and maybe a couple others. And you have ETFs. There are high yield ETFs. There are some mutual funds that pay a significant income. And you have the oldest type of fund of all in the world is the closed-end fund, which nobody knows about. And it pays higher dividends and more frequently than the others do. And it's a different form of security. It's actually a managed trust by a private portfolio manager that manages this trust, and individuals own stock in that trust. They don't own the individual securities themselves. So it's a different type of security, but they own, within them, you can buy closed-end funds that use covered call writing, that contain CLOs, that contain MLPs and REITs, some few BDCs. And there are, like I said, high yield ETFs that contain a lot of BDCs to cut down the risk there, plus the other things as well. You can even find ETFs that have closed-end funds in them. There are four of them.
Well, the interesting thing is about closed-end funds, because I'll get this question from advisors quite a bit. I'll be like, is a closed-end fund, is that an alternative or not? And the reality is, so you're the expert in this space, but this is what it looks like to me. So correct me if I'm wrong. Your closed-end funds are traded on major indices in the U.S., correct?
Right. Yes, and overseas. In most places, in the European Union, you have to have a designation of a expert or a professional investor in order to do them. But most places you can use them through various brokers. But they are different for sure. Are they alternative? I never, growing up in the trade, I thought of alternative investments like the ones I mentioned to you. The other types of funds, the REITs and things like that, as an alternative. And there are some illiquid type investments that fit into the alternative mode, which I wouldn't touch with a 10-foot pole. But there's a lot of different things. There's a lot of gold types and futures and even options programs that are alternative investments. As far as I'm going to go is covered calls, and only in a closed-end fund environment. You know what I mean? So are they? Do they contain some alternatives? Possibly. Should they themselves, if I have a closed-end fund that's got 350 different municipal bonds in it, doesn't seem like an alternative investment to me. It seems like a pretty safe, secure, very conservative, low-risk investment. And alternatives have a connotation of higher risk. And I don't.
Correct.
I don't believe that closed-end. I believe closed-end funds are minimal risk because of their management, diversification, and the way that you can look at them to make sure they fit all the rules you said about quality, diversification, income generation. And of course, I have my rules about profit taking. So yeah.
Well, here's the interesting perspective from an insurance carrier's perspective. Okay, because a closed-end fund, when it's publicly traded on the U.S. stock market, it ends up having essentially that wrapper, that regulatory wrapper around it that makes it plain vanilla just by the nature of how it's structured, which is really
Right.
cool, because you've also just mentioned there's several strategies that can be used within the closed-end fund, but because it's publicly traded company in the US, it's plain vanilla. So you can enjoy some of the benefits of those more unique strategy, which you could say, alternative strategy packaged in a plain vanilla. Now you can also do that, like you said, with the mutual fund and some ETFs and stuff like
Yeah,
that.
but not as easily.
Yeah. So yeah, go ahead.
But another thing, like you were just saying, think about where advisors are when they're talking about corporate bonds, municipal bonds, even preferred stocks. They're not liquid, right? You have to negotiate basically every time you buy or sell one. They do have an invisible charge on them that does benefit the advisor. He gets a piece of that, I'm sure. But the house gets a lot of money by selling individual bonds. Now think of the fact that you can trade instantly a portfolio of 350 different municipal bonds of all over the country like it was a common stock with no charges.
Right.
At all.
You don't have to go out and buy the individual
accrued
bond.
interest to worry about. No premiums or discounts to concern. Nothing. It creates liquidity in an illiquid market. And for any advisor who feels the need for income investing within and has his eye on the client, not his own package, these are, like miracle drugs.
Yeah. Well,
when I discovered them, within 6 months, I transferred $50 million from individual fixed income securities to closed-end funds.
Well, how'd you discover them? How'd they show up for you?
The equities were a little bit sooner, even though I had a couple of them before I even knew what they were. But I got a client who happened to have a couple closed-end funds in his portfolio. And typically when I go through and transition to my group of wonderful dividend payers, equities and things, I always look to see what kind of yields the stocks are paying. And I saw high yields here. I said, I don't know about these things. What is this thing? And I asked the guy, tell me a little bit more about it. He said, they're called closed-end funds. And somebody told me about them years ago. And they've been paying this kind of income. And I love them. And I said, well, I don't blame you. I think I kind of like them too. So then I discovered how many there were. And then I discovered the idea that they're full of illiquid securities and they're giving it to you in a liquid form. And I did. And I just said, well, wow. I mean, this is a eureka moment for me. And I converted my whole income, everybody's income side of their portfolio became closed-end funds. One guy who lived on Long Island fired me because when he got his statement, the statement, since they trade like stocks, this statement said that his portfolio was now 100% in the stock market. When really it was still 50% in municipal bonds. I said, hey, George, look inside. These things are portfolios of municipal bonds. They're paying you more tax-free income than you were getting last month by a long shot. He didn't believe me. He said, no, they can't be. They say they're stocks. The company says they're stocks, bam. And still today, if you have a regular portfolio with the Fidelity or anybody, it'll show you in that chart, the pie chart, that you're still in the stock market.
Right. Which is actually an advantage for the financial advisor. That's my opinion.
Why's that?
Because that means it is liquid. It's plain vanilla from a risk standpoint. Now, this is strictly from a carrier standpoint. It helps you find your insurance risk transfer becomes a lot more cost effective when it's publicly traded in the US and it has that liquidity. Now, there are things that are very important for a good advisor to know how to have that discussion with the client, which is what you share with us in this book. So I think those advisors that are working with those retirees, within that window, what is it, 5 years on either side or 5 to 10 years on either side, if they don't know about some of these strategies that you talk about in here, it's worth them getting, $20 and read the book, right? If nothing else, it might help them find something that's useful for them, is what it looks like to me.
Yeah, I got a call a couple days ago, actually, from an advisor, and he has a pretty big firm.
Mm-hmm.
And there are two of them, and he's got two different locations, a bunch of employees, and all these things. And he said, I really want to bring this style of income investing to my senior clients. I want to bring them more income. I want to be able to tell them how much income they're making and how they're not going to have how the 4% rule is no longer going to be their method of operation. They're going to have more income than they're spending, And I was so excited about this that, I said, okay, whoever you need, whoever you want me to talk to, whatever types of Q&As you want to set up, you got me. Just call me up. We'll set it up. No charges or anything like that. We'll do it. The two of us, and we'll train your people and we'll educate your clients. And that's how I approach it. The more advisors that discover what you just pointed out, that they can have preferred stocks and corporate bonds and everything like that in a tradable, liquid fashion within their portfolios and generate more money than their clients need to spend, those are the type of guys I want to talk to.
Great. Now, if they're an advisor that are just starting out and they're establishing their principles, I said that's a good idea too, I think personally, because or if you're a brand new advisor, you're exploring breaking away as an RIA or being an advisor, the first, 5 chapters or so is like living the client experience as you go through that. And that I think is valuable for a different type of advisor. And then when you go into that third section of the book, when you're getting into the principles, for the advisors that have been doing this for a while and they really want to nail that down, if they're not just an asset gatherer, but they're actually managing portfolios, it's a particular type of high quality advisor, right? What are some of the principles that you find to be the most helpful as you were an advisor? Like, these principles I just could not live without.
I had a unique advantage when I got started as an advisor. And that was the advantage of having my own portfolio up and running, visible, that they could see. And I used to tell my clients, because I rarely found a portfolio that was larger than mine, or at least not by a large amount. Until later on, that didn't happen. But I used to tell them, and this is something I think every advisor should expect, because I've written articles like vetting an investment advisor. And the first thing I tell them is what I did was I told my clients, I will never, ever buy anything for you that I don't own. And if they can live with that, they're going to have a clientele that respects them and trusts them.
Well, you eat what you cook is what you're kind of saying there.
Yeah. I mean, I stuck with that, and I still do it. Like those in the book, I talk about my selection universes.
Yep.
And I can still say it. I have 230 non-tax-free closed-end funds. 25 of them are high-yield ETFs. I can still say to my clients or to my audience, I own every one that I'm putting in the universes that you're looking at. And I also tell them I only have half of the tax frees because I'm just not a nut on taxes. And I know I make more money on the other stuff. Even the 7% yield I can get right now doesn't make me want to own that many more of the tax frees. I own about half of those. So
right.
that's something, that's a rule an advisor can go with, and he'll never make that pressure decision of the stock of the day or the model portfolio of the day. Because when he looks inside, he'll see stuff there that he wouldn't touch, ever.
And you know how to look under the hood.
You got to look under the hood.
Yeah. And this book, you walk through that process. One of the interesting thing that really comes up, and I think this is really timely because the 2025 so far has been fascinating if you only look at the waivers in the market, right?
And that's what most people look at, yeah.
Right.
I mean, the S&P is just about at break even right now for the year.
Yeah. And we had a pullback. Yeah.
And October, the others are October and August, I believe. The other two indices.
So we're recording this in mid-May. So I think it may come out in June. God knows what's going to happen between now and when it comes out. But volatility may be here for a while. And if that's the case, you talk a lot about leveraging volatility in the book, in your strategy, and how that actually gets you. Historically, you've seen it come up with better results. I would love to hear a little bit more about that, because I don't know, maybe I'm wrong, but it looks like we're moving into a higher volatility period for a while.
Okay, let's talk about volatility.
Yeah.
Volatility is the very nature of markets, particularly the stock market. Volatility is perhaps a little less in the bond market because it's more a function of interest rate expectations. But in this current environment, even interest rate expectations are going to be volatile because we have this battle going on between the Fed and one guy wants it to go up and the other piece, whoa, wait a minute, you can't lower interest rates when you're in this type of uncertainty. And uncertainty is another thing. There is no such thing as certainty in the marketplace. So volatility and uncertainty are the nature of the beast. You got to wrap your head around that. And then you have to develop a methodology that allows you to take advantage of it. And that methodology is very simple, really. You have to have targets, profit-taking targets that make sense based on what these types of securities, fund security like closed-end funds isn't going to have the type of volatility that the individual securities inside will have. So I changed when I switched one to the other. I changed from a 10% target. And when I started that 10% target, it was after commissions 10%, because we were dealing with like almost a 2% commission rate in those days. And then now it's a fee-based, and I got problems with the fee-based thing too, but I think it's caused a lot of problems. But so anyway, a target for your profits and rules for how you add back into knowing when if the market's at an all-time high, it's going to go down eventually. So that doesn't mean you should stop buying equity securities because the stock market's at high. You just don't buy your complete position. You buy maybe half what you'd normally buy if the market were down. So you know that range. Okay, at market highs, my starting position is $4,000. At market lows, my starting position is $7,000. And you set guidelines for yourself. So it's easy to know where you are in the market cycle. It's impossible to know where you are going. You only can know where you've been and where you are. You don't know what's next. Course,
I think that's a business principle, a principle to live by for me, for what we do here.
Of course.
but in the marketplace, in the advisory, the arena the advisors work in is a arena of speculation on what's going to happen next. How many different experts were predicting a correction right now? How many others are saying, no, we're not going to have a correction? You know what I mean? Everybody has their own opinions, and they're getting paid for their opinions. And we all want to think that they know the future, and they just don't. There are no crystal balls in the equity or in the bond market, for that matter. You know, and you just have to live with it. So you have to have rules. And what the book describes are rules, and there are some rules and there are some guidelines. And by bringing in the market cycle and knowing where you are, and you can make a determination of what your next moves are. I actually try to always be fully invested because of the yields of the things I'm invested in. And when the prices of these things go up like they did, 5, 6, 7 years ago, when interest rates went to zero, these interest rate sensitive securities went up like crazy. And of course, I still own some of the ones I bought then, but they're still yielding 7%, 6%, so that's fine. But you have to realize that you've got to prepare for things going in the other direction. And that's
right. You plan for the unexpected, so to speak. You
plan for that, and you operate accordingly. So if let's say you are at a high level of the market and you do what I just said, you only put $4,000 into ABC, and I don't mean that ABC literally. I mean XYZ, whatever. You buy it. You only put 4,000 in it. Two things can happen. The market can go down. It goes down 10% or more. You can add to it, and you reduce your cost basis overall. And then when the market goes back up, you can either sell the first lot if it goes up to your target, 5%, or you can wait a little while. Generally, I sell it. But anyway, or if it continues to go up, what do? You take your profit. Right. So there's no real downside if you prepare for those downsides. You can take advantage of it by buying more. I never buy more of something twice in the same month. I spread it out because I have so many, and they're all going to be down. The closed-end funds are since they own all the securities you can possibly think of, their movements actually mirror what the market's doing.
Right. But there's one thing you illuminated to me, with the closed-ended funds, is how for income generation, they have unique opportunities in helping generate the income where frankly, you don't see in a lot of other investment types. Oh, no, you don't. I mean, when we had that crash, the COVID crash, the 2-month crash, we had COVID. I was so upset that it only lasted for 2 months. Because I've got $40,000 a month coming in distributions, and I want to be able to put that to work at low prices. Now, come on. I was trying to survive as a business here at that point. We made it through, and we're stronger for it. But we in the community that I run, when we see a bad day in the market, if you took a snapshot of everybody there, they'd be going like this. Yeah. Okay. Opportunity. Okay. Here's what I want to do, if you're cool with it, Steve. We're gonna leave some of that. Your strategies and what you have to tell us in the book, we're going to set that aside for a minute, if you're cool with that, because the one of the other cool things about your experience, Steve, is you ran an RIA. Okay. And in my day job, I'll say back at Box Professional, we work mostly with RIAs. And so you had, 40 years, something like that? You ran an RIA? I had an RIA from when I started till just about the turn of the century, just about there. Because, the regulations for RIAs are, it's like a chokehold, and it just kept tighter and tighter. So when we changed, we were working within big operations like, a bank would take over the last one and we'd be moving around.
So we found a smaller broker dealer that didn't try to manipulate you. They didn't put their advertising materials in the stuff that was going out to your clients and stuff like that, like big guys do, you know. So we found a smaller operation, and it was easier for me to work through their IRA as an IAR. And, you know, IAR was something independent retirement. I don't even remember.
Independent registered advisor.
Yeah, something like that. Something like that.
Yeah.
I was an advisor rep instead of a registered investment advisor. So that's for the last part, but it's still pretty much the same, except I didn't have direct SEC supervision, which was really a big relief, you know? So
Rob, yeah,
I was going to add, man, I got a chance to ask Steve a question.
Yeah,
we've been rolling.
You guys are rolling. You guys are rolling on the philosophical side of investments and that sort of area. I want to get in the nitty gritty of the business side of this.
Okay.
Because I think there's a lot of RIAs out there, a lot of financial advisors. They want to understand how to build, grow, and scale their book of business, and how can they best do that and really model. Bring the philosophy that Steve has, and how do you marry that with, I still have to grow a business. I still have to build my business. I want to market my business. So I want to dive into two things. Number one is I want to talk about your experience and how you grew your business. And then we're going to pivot that into how you then eventually exited and share a little bit about your experience of making that transition. So let's start with this. Steve, did you have an area of specialty or expertise that really differentiated you from all of your competitors?
Yeah, I think I did. I wasn't a day trader, but I was a stock trader. I was an income focused, high quality securities trader. Okay. I guess you could almost compare it to what my dad did with the rental side of his real estate business. You had to have those rentals to save you in the times where you couldn't sell real estate or houses profitably. People weren't building new and stuff like that. So he had rentals, and the rentals always generated that income. So I approached my equity business, my stock market and bond market business, as developing income streams. I wanted to get money from the distributions that were coming in, and I got money from the profits I was taking. So I had two streams of income at all times in my personal in the portfolios that I developed for people. And that was a good sales position. I could take my portfolio and show them how much income I was making, because the statements make it very clear. Just like today, if I took a snapshot of my Fidelity, for every portfolio, and they stopped giving you a combined one, but they give you individual ones for each portfolio. It gives you your projected income for the year. And what I tell my people, the way you measure your performance is you want to see your working capital grow, and you want to see your monthly income grow. I say your quarterly income grow, and you want to see your projected annual income growing. And those are the only three numbers you need to look at. Market value will take care of itself. If interest rates are down and the market's up, your market value will be up. If they're not, it won't. It's that simple. It doesn't matter. The income's the same. You want it to be growing. So that's what I showed people. I showed people these are the numbers that I'm pretty certain are going to continue to come in. And that's what I used to show them right up to the time that we left the business. I would show each person, go to your Fidelity statement, look at the projected income for the year, compare it with last year. Okay. If you didn't spend more than you made, or more than I made for you, your income is higher now than it was then. It's that simple. So
Wow.
that was a very simple concept for people to develop. And today we have an environment where it's all returns. And that comes from total return, which was developed about the same time, I think, as people went from to a fee basis from commission basis.
Mm-hmm.
And they just tried to somehow soften the down markets by adding the income in a little bit, make it look not quite as bad.
Mm.
It never worked to me. And when somebody talks to me about total return, I said, it's total BS to me. It's total realized return. Now that means something. That's in your pocket, man. That's something you can spend or reinvest. You've got a choice. Total return, it's, it can be gone tomorrow.
It's true.
So those are the types of things. If you're starting off in an advisory business, I think you're going to have a lot of trouble if you don't already. Somehow you got to get your own investment portfolio, or even a this is what I propose portfolio, and show the actual securities that you're planning to put in for that person and what income they generate, and show the volatility. Make volatility a good thing. Show how that volatility means I can buy this for you when it's down and sell it, buy it when it's lower and sell it when it's higher, with a minimal target, so that I can compound and develop this stream of income that compounds and just keeps growing that working capital, and that working capital keeps producing more income. That's you have to change your mindset in order to change their mindset. And right now, your mindset, unfortunately, you get paid on AUM.
Mm.
I used to tell my clients, I said, there's nothing but good news out there when the stock market goes down. It gives me the opportunity to take your income and reinvest it at higher yields and lower prices, and you're paying me less for doing it.
Mm-hmm. Mm-hmm.
Wow. There you go. There,
Okay.
that is it. That's what I love to hear. Okay. So for anybody who's listening and watching right now, did you just hear what Steve said? This is my big takeaway, Steve, from this. Is when you're talking to clients or even prospects, you actually have to show and tell. Like, that's marketing 101. Show what you do, how you do it. But we have to be careful, obviously, in this environment. Chad and I have had a lot of compliance people on the show. So, and I can always jokingly say, every guest that's been in the compliance industry that we brought on, I've always said, is compliance your friend, or is compliance the sales prevention department? Like, you choose, right? What's your philosophy on that, right? So we have to be careful sometimes in the claims we're making or how we show. But I think what I love what you're sharing is, and not enough people do this, is let me show you what I do. Yeah. And actually, let me show you from my perspective and how that fits into my philosophy. Classic example, Steve, is I have a content agency. We do podcasts. Like, we fully produce podcasts. Well, yesterday I was on a call and I showed that person, and I took a page out of Chad's book. I showed that person, here's what we will build for you. And I showed them a real example of, hey, here's some sample shows. Here's how we take content and repurpose content. Here's how we manage everything for you. Here's your content calendar. Everything's organized. And guess what? This is the exact same system that I use for my podcast. So I built that system based on my own experience with the work that I do for myself. And then I share that with others. It's the show and tell show.
Exactly.
So I love what you're sharing, because that's the greatest marketing piece you could ever have. If you're looking to grow your business, show people what you do, show them the results, show them the outcomes, when shit's pardon my French. I shouldn't.
Oh my God.
Well,
Never heard that word before.
We're family friendly.
Remember, you're talking to investment advisors. They hear that stuff all the time.
Yeah.
I'll tell you, I'm not going to embellish on this too long, but Steve, if you have some time, go to my LinkedIn profile sometime and check out. I had a podcast episode one time that I brought on two guys who are running an insurance agency. And what I did is I posted on LinkedIn one of the bloopers where I mispronounced his name. And then I had a cuss word. I went, but what I did is I used that as a blooper that I posted on LinkedIn as an example of how I'm fallible. I'm human. I make mistakes, but I use that to my advantage. So I posted it on LinkedIn.
Well, that's what I did with my first two clients. I showed them my portfolio. This is what I got. This is what I have now. This is the amount of income it's generating.
Mm-hmm.
I can do that for you. And these were my dentist and a buddy I met. My wife and I met on our first cruise together. We met them. And I just spoke to him on the phone 2 days ago. The other guy, I don't think he can speak intelligently anymore, but they're still around. But that's how I started. And then I did that. I kept my own 5, 7, 9, 10-year statistics showing how the income was growing and stuff like that. And I just show it to people. And finally, Wynn would introduce me to somebody, and, somebody else would introduce me to somebody, and it just grew and grew. Then we started, I got on a couple talk shows. This was before there were no podcasts. I got on a couple talk shows on the radio. We went to trade shows, and we'd set up a booth at a trade show, and we'd have charts on it, and people would come in and look, what are those stupid charts you got there? And so, so we just did that. And then I wrote one book, and then I wrote a second, and then finally I wrote this final one. And I say final, and I mean that. I'm never going to do that again.
It's quite an effort to do that. We've had some people on our show that have written books, and they're like, man, it's a grind. So let me ask you this, like, let's get in the nitty gritty.
Yeah, go ahead.
So you built a really nice business, and as you're just talking about it right now, you're like, I grew it. What was the one thing that really made the difference for you other than the show and tell approach? What was the one thing that was really your secret to success, Steve? Was it a combination of writing books and building credibility? Is it getting, you had just a referral machine going? What was that one thing that, if you could share with people who are listening or watching, that you would recommend that they do to really start building that growth engine in their own practice?
The most important thing, and I can tell it with one statistic. I don't think in 1987, there was a crash of 87. I think I got 2 phone calls. In the dot-com bubble, I didn't get any phone calls. In the Great Recession, I didn't get any phone calls. In the COVID, I didn't get any phone calls. When people know and they see the income is continuing on, when they know what they own inside, when they look inside it, in the old days, they looked inside and they knew the names of every company. They walked by them every day. They walked by some of them, and when they went shopping, when they're familiar and comfortable with what they own and with the income they're receiving, and you communicate with them. And I was fortunate. I communicated with them. I never, ever. I said, Ken, if you want to send this to compliance, you go right ahead. But I'm sending it directly to every one of my clients today, because now's the day they need the information. I'm not going to wait 3 weeks for some get it in compliance, say, oh, you got to dot this I and cross this T. Forget it. I'm talking to them now. They're my clients. And that's, it's got to be clients first. It's got to be clients first. And you got to say, and if you do that, you won't have to worry about how much you're getting paid on AUM. It's going to be plenty. It's going to be plenty because you're going to develop a big business.
That's awesome.
I was managing 110 million in capital for my clients.
Well, that's the next transition. The next transition is, Steve, before we started the show and before we pressed record, I asked you a simple question, and I said, hey, would you mind sharing your experience with your exit and talk about how, especially given the M&A environment we're all in, by the way, the insurance industry is like this as well right now. There's a lot of activity going on in that space. Obviously, same is going on in the RIA space. Share a little bit with our listeners and watchers about your experience. And obviously you said, I'm happy to share the good, the bad, the ugly. Would you mind sharing, like, how did that whole process unfold and share that experience?
It was 2023, right? 78 years old. Been managing this money for a long, long time. Happy as a pig and, no problems or anything. But knowing that I had to do something or slow down or something. But anyway, the company the broker dealer we'd been working through since, like I said, it's about the turn of the century, was taken over by a bigger broker dealer. Mm-hmm. And as they were discussing it, they were looking at the individual firms and trying to determine if there were any old folk, or, that's what it looked like to me, that might be interested in selling out completely, their whole practice. And my partner was just 3 or 4 years younger than I, and not quite as in a good health as I am, and ready to get out. And they made us an offer we couldn't refuse. It was the equivalent, like I said, of 6 years income gross in advance. There are a lot of stipulations in the financial industry. You got to maintain your AUM for over a year before you get the back end and stuff like that. So I agreed, I'm all up for this, but I got to figure out if I can still maintain my lifestyle, because I had my own portfolio, and with the upfront, if I put that in there, am I going to have enough to do the vacations and all the other stuff? And we figured that all out. So a couple adjustments were made, and I felt that I was capable of doing that. A month or so maybe might have been a problem, but that's about it. And I said, you're still going to be, the remaining people are still going to be a part of this organization, and you still have this specialized product that we've been selling and that we've been marketing and that our clients have been faithfully with us for all these years. And it's unique. We literally, I can't think of anybody who can refute this. We were making more money in income, realized income for our clients, than anybody else. In 2021, we made $7 million in distribution income and another $7 million in profits for our clients. That's how we got to 110 million. We started with around a little more than 90, and that's what we ended up with. So nobody else does this. Nobody else focuses on income. Nobody has this quality diversification income, this profit-taking discipline. They don't do that. Tell these people what they're getting, and if they were then to take that product and focus on the community that's from 60 years old to 80 years old, they would be alone out there. They would be the only ones providing this to millions of people, and they could make a fortune with it.
Well, you had a very, very nice exit, and it pains me a little bit because my box professional brain side of it says, oh no, I don't want my clients to be aware of how great it can be. But we appreciate you definitely sharing that with us, Steve. And I'm curious, you also mentioned something about, you're a realistic guy. You're at the stage of life where this makes a lot of sense, and you still get to be engaged with your book and coaching and stuff like that. How was it as you navigated through the, wrapping up? Because it sounds like you've wrapped up all the things that you needed to do to finish the whole thing. Is that right?
Oh yeah. I mean, we did everything. It's all over. I've gotten all my payments and I'm happy. And
what'd that tailing out process look like for you?
Oh, I was so busy with the book and with setting up the coaching business. I mean, it was pretty successful that first year. Now the coaching is pretty much transferred into the income investing community that I run. Mm-hmm. So that I do the coaching all the time in the form of Q&As with the community. Mm-hmm. And then if anybody really wants specific, then they get me for half price to do it privately. But it's kept me busy. I have people that can do things for me while I'm away on vacations and stuff like that, that are well-trained and skilled, So I'm, you say, as happy as a pig and, and
good for you.
Still having fun. So,
well, the funny thing, as we land the plane, Rob, did you have any other questions before we get there?
No, I feel like Steve was going to get into the good meat stuff. Well, I feel like you kind of cut it off. And
I did. I did cut one thing off, and I think it's an important piece of information.
Yeah, well, bring it in.
Where I was going to go with it, Steve, is sharing what you learned from that experience and really like the downsides, like be honest and transparent. Like, what was the bad stuff? Like, that you would have done differently or you wish somebody else would have done differently? And what do advisors and RIAs who are looking to exit need to look out for is basically what I'm saying.
Well, I guess what you need to look out for or be prepared for is you're not going to get your money up front all at once. And if you don't have an income machine of your own, you're going to wind up using some of that principle to keep you alive until you say, wait a minute, I got to develop an income portfolio. But you got to make sure you have an income portfolio in place first before you take that, so that you don't have to spend it. That's one thing. But the other thing, and I guess what I saw, they said when we told them what we had, it was pretty, frankly, Scarlett,
Yeah.
That's not what we're about. So think about the opportunity that's there in that space. There is still, I have one guy that I refer people to within my community that is focused just like I was. I had that guy I mentioned to you earlier that is beginning to bring his whole operation into an income focus for the select people in his practice that need income. But the reaction that I've gotten, for example, on LinkedIn, when I talk about, I put out a piece with that Fidelity projected income box, and I put it out there and I said, something like, what is your projected income for the upcoming year from your investment portfolio? And I got, the longest response I got from any financial advisor was that I was a snake oil salesman. That's impossible. You can't do that. Like, you made those figures up, because they don't appreciate it. They don't understand that there are these easy to use income focused investments out there that they can put in their clients' portfolios and get them this type of income. They just don't know it's there. I really honestly think that. I don't think they're avoiding it on purpose. I just don't think they know it's there.
Well, then you're bringing up two really good points. If you don't mind, Chad, there's two things that I see some parallels in the insurance industry, because I've been in the insurance industry over 2 decades in my career, and now do something very similar to what you do, Steve. I run an agency and do some coaching and some training, because I really want to see the younger generation of producers be successful, but most of them aren't trained very well on, number one, product knowledge, but number two, it's how to deliver a world-class experience to customers, and what it means to communicate with them every day and to be valuable to them and to show them that you care. And I think what happens is a lot of these younger folks, they get into these institutional type of operations where everything's cookie cutter. You got to say this. It's very robotic. And, that's why I'm a big fan of like boutique, and I'm not saying small agency. I'm talking about a nice sized regional agency that you own and you control, that you have a lot of flexibility in how you serve your customers. And so you're not being shackled or, feel like you're being stuck in this jail of like, I can't do this. Compliance says I can't do this, or I can't share this. That's why I think it's such a great thing to be independent and really have control over your future and not feel like you're stifled by your own creativity and the way you design things. Steve, the way you're talking about is like, it's very similar to something I would design for the folks that are in my coaching program. It's like, hey, well, let's design a world-class program that solves this problem and gives this specific result and outcome for your customers.
Right.
Right.
Exactly.
So I'm so grateful that you shared that, because I think this is a really great learning moment and like learning experience. And I think it also speaks to the value of the people that we're bringing on our show and folks like you, Steve, who are truly doing something that's world-class and thinking outside of the box and not following the corporate bouncing ball. There you go. There's my rant about the corporate America and our industries.
Well, I think you put it very nicely, and it shouldn't have caused a lot of pain, but may get a lot of attention.
Yes,
maybe so. That's okay.
That's what we can hope, right?
We might hurt some feelings, but that's okay. You know what? One last thing. You said something really interesting. Remember when you said you were making your transition from your commute going into the city and your job, and how I think maybe it was your wife who said that you're just so upfront, and I don't know if it was brash or just like you speak your mind.
Yeah,
I'm kind of the same way, and I get a lot of flack for it, and but I'm okay with it because I'm real and I'm authentic, just kind of like you, Steve. We have very similar personalities, I think.
Yeah, when you were in the organization I was in, you didn't tell your boss when he asked you to look at something he was sending out. You didn't look at your boss and say, "You're using that word wrong." You didn't do that. I did.
That's awesome. I'm sure. There you go, Chad. I think you probably want to make our. You're probably ready. You're just making your approach right now, and you're just about ready to land. And I'm sure Chad has his famous legacy question.
Okay. Well, it's kind of funny. First of all, Steve, I've got to thank you for taking your time, because you could be out golfing or doing something fun with your wife or on a cruise, and so you're taking some time with us today to talk about this, and just your generosity to the investment advisor community to help share with them, because you didn't have to share what it's like for you. You could sail off into the sunset. And our kind of last question is usually, what do you want to be known by? Now, you're in a unique position if you are, I think you kind of have established that with your book, but you're continuing to live it out, which is absolutely phenomenal, we're going to do it a little bit differently today. I'm going to tell you what it looks like, and then you say, "Oh, no, Chad, maybe that's wrong. This is what I also want to be known by." Okay?
Okay. Fire away.
So what I see is you have a heart for those individual investors to help them understand how they can do it for themselves. And one of the things I loved about your book is you also, as going through that, you show the advisors where they can add value for the individual investors. Kind of embedded in this whole conversation is, this is what you can do. This is how you can do it. You lay it all out there. You have a huge heart to just give of yourself. Yes, you have some coaching and there's some help, but there's a lot of support and value there to help others be successful. That's what I see. Am I reading it wrong?
No, I thoroughly would love it if there were dozens of professionals, and like you were saying, it's going to have to be smaller practices, I think, that really can get a hold of this and be able to exercise that type of control over what they're doing for their clients. But the more of them that I can help get started, the more of them that I can participate and I mean, I'm going to make some money. There are people who are going to buy books. They're going to buy them. I'm going to make a couple bucks here and there. No big deal. They join the community, I'll make a few more, but they are going to make out like bandits, and their clients are going to make out. Their clients are going to be able to say, hey, this is cool. He's worth the 1.2, 1.3% I'm paying him because he's making me 9.5%. He's worth it. I don't have to do it. I'll just go sailing, and he'll make sure that money's coming in every month.
Absolutely.
Yeah. That's what I want.
Fantastic.
That's what I want to see.
I love it. That's the beauty of this show is and why, Chad, it's in our hearts to bring folks like yourself, Steve. So we're extremely grateful and honored that you took the time to be here with us. And we're going to put in the show notes, we'll put how everybody can reach out and contact you if they're interested in learning more about you, Steve, and maybe purchasing your book as well. I know where your heart is, and I know where our hearts are, and we want to just help add value to this industry because we believe it's a great industry to be in. And if we can help the next generation of, even in my world, the insurance industry, financial services, all of these are so intertwined and connected. We just want to make a difference and serve the people who we're called to serve. So thank you, Steve. We really appreciate you being on.
Well, thank you guys. It was a pleasure. Great conversation.
Well, and another episode in the books and another good one. And again,
absolutely,
we really appreciate your support. Please like, subscribe, and join us in this community and on this journey. And we'll see you guys on the next episode of the Advisor's Edge podcast. Take care, everyone.